Hello and welcome back to another stock analysis on Stock Market Palantir. Make sure to subscribe and let us know your thoughts in the comments. Now, let's hear from our analysts.
The action in Under Armour, ticker UAA, in the final weeks of 2025 was nothing short of a spectacle. I mean, we are talking about a stock that managed to rise for 9 out of 10 trading days, solidifying heavily in that, that crucial 462 to 478 range. And it was often on volumes far exceeding its 30-day average.
And we know the engine behind it. The engine driving that intense accumulation was Fairfax Financial. This wasn't just passive buying. V. Prem Watsa, the guy they called the Canadian Warren Buffett, he aggressively deployed capital. He acquired, approximately 15.68 million shares just between December 22nd and December 29th.
Right. He injected roughly $70.9 million into UAA in a single week.
A single week, yeah.
And that level of concentrated, high-conviction buying, it brings us right to the core tension here. You've got a stock that's priced for total failure, suddenly backed by one of the most respected deep value players in the world. So the central question for everyone watching this is, does this overwhelming institutional vote of confidence establish a definitive price floor, a signal of a genuine turnaround? Or is this just short-term technical noise, masking, these severe, persistent, long-term fundamental risks that scream value trap?
And I contend that the overwhelming financial and, frankly, brand deterioration is just too severe. It's too severe to be erased by the actions of a single buyer, no matter how revered he is. The risk of this turning into a massive capital black hole, I think, outweighs the allure of a low valuation.
I see why you think that, but let me give you a completely different perspective, one rooted in asymmetry. My position is that the institutional action by Fairfax, coupled with the clear technical structure emerging on the chart, confirms that a major accumulation phase is underway, and it's one that has already established a highly protected downside floor. Watsa didn't just buy, he planted his flag. His purchases were executed at a weighted average price between $4.35 and $4.73. By increasing Fairfax's stake to 16.1% of the Class A float, he is telling the market he found the margin of safety wide enough at these levels. He has effectively set the Watsa floor.
That's a compelling argument based on conviction. I'll give you that. But conviction doesn't pay the bills. Operational results do. And the operational results are deteriorating. This whole accumulation event is, I think, a distraction from the material reality of the business. Management reported a fiscal second quarter loss of 4 cents per share, and, critically, they adjusted their full fiscal year 2026 revenue guidance downward to a decline of 4 to 5%. That's the cold, hard data the market should be grappling with, and it points directly to structural weakness, not some temporary inconvenience.
But that weak guidance is not only priced in, it's drastically oversold. We cannot ignore the valuation context here. UAA is currently trading at a price-to-sales ratio of just 0.56. Let that sink in. The market values every dollar of Under Armour revenue 80% less than it values Nike, which trades near 2.8 times sales. The stock is literally priced for bankruptcy, not merely for a slowdown. I mean, stabilization alone offers an asymmetric risk-reward profile. And what's more, the short-term market dynamics are confirming this shift. The 14-day RSI is sitting at 61.85, firmly in the bullish control zone, and the MACD is positive. The momentum has decisively shifted.
Momentum is a technical artifact. Brand perception is a long-term liability. Retail analysts consistently flag Under Armour as a classic value trap because the brand has hemorrhaged its cool factor. It's being systematically relegated to the discount rack. It's no longer competing with Nike or Lululemon. It's competing with mass-market clearance brands. You can't execute a profitable turnaround when your product perception has been so fundamentally damaged. And while yes, the stock has seen a short-term pop, it remains structurally beneath the critical long-term resistance, the 200-day moving average. The death cross is still in effect, signaling the long-term downtrend. Fairfax's $70 million bet relies entirely on management's ability to execute a nearly flawless multi-year premiumization strategy. That is a colossal operational risk.
Okay, so let's focus right on that first point. interpreting the Fairfax signal versus the fundamental decay. I argue that the timing of the Fairfax purchase is precisely what makes it such a high signal-to-noise event. I mean, think about the conviction required. Watsa increased his stake by nearly 60% immediately after they announced a revenue guidance cut. He is buying on maximum bearish sentiment. This suggests he believes two things. First, that the operational issues are temporary consequences of a necessary pivot. And second, that they're already oversold. This is a massive vote of confidence in management's strategic pivot. Exiting undifferentiated wholesale channels and focusing on core profitable products.
I'm sorry, but I just don't buy that the operational issues are merely temporary. This isn't a cyclical inventory correction. This is structural brand decline in a hyper-competitive market. A single institutional investor, even one with a stellar track record, does not erase that structural problem. The premiumization strategy you're championing is inherently painful and dangerous. It means reducing promotions, consciously exiting high-volume discount channels. This guarantees further revenue erosion in the near term.
Yes, but it's eroding unprofitable revenue. It's allowing them to rebuild margins.
But at what cost? You're assuming that just by reducing visibility in low-end stores, you instantly reinstate the brand's premium status, that you can suddenly compete with a company like Lululemon, which has spent a decade cultivating that exact image. Reducing inventory risks more revenue loss without any assurance that the brand can actually capture that athleisure market. The market cap is compressed to just over $2 billion for a reason. The risk that they shrink their revenue but never regain the cool, it's substantial. It's existential.
But that is the essential deep value thesis. The valuation provides a tremendous safety cushion. If they merely stabilize, if they only manage mediocrity in their turnaround, and the stock re-rates to one-time sales, still far below every major peer, the stock essentially doubles. The market has baked in such a high failure rate that even partial success results in massive returns.
That's predicated on the idea that the entire market, except for Fairfax, is irrational. Let's drill down into the microstructure, what the rest of the market is doing. We still have a persistently high short interest, sitting around 16 to 17% of the total float. That represents a significant contingent of bears, professional skeptics, who are still committed to the downside and haven't covered. This indicates strong, persistent skepticism that any of this short-term support will hold. Any technical failure will be aggressively amplified by these shorts.
That's a fair point on the short float, but that's where my fundamental disagreement lies. We need to look deeper, specifically at the dark pool activity, which suggests that smart money is actively accumulating precisely by masking its position off exchange. You point to short interest, but let's examine the dark pool short volume data. We saw that ratio peak at 52.04% on December 17th.
Okay, so explain that. Explain why data showing high short activity is significant for the bullish case. That sounds completely contradictory terms.
When a massive buyer like Fairfax wants to step in and absorb 15 million shares without causing a huge price spike, they aggress on the bid. So market makers step in to satisfy that overwhelming institutional buy demand by temporarily selling inventory they don't have. They're shorting into the bid to ensure the institution gets their fill. They then cover those temporary shorts later. A dark pool short volume ratio over 50% doesn't suggest bearish sentiment. It suggests intense underlying buying pressure that market makers are struggling to satisfy. It's evidence of hidden heavy accumulation.
So what you're saying is that the very data showing extreme short activity is actually the smoking gun for hidden, high-conviction long accumulation. That's a huge claim that relies on a very specific execution mechanism.
It's not just a claim, it's how large-scale distress investing is often done to minimize market impact. And this hidden absorption is further supported by how the volume was distributed. We saw a distinct barbell distribution, heavy volume at the open and, more importantly, at the close cross. Volume at the close was 24% higher than the 30-day average on December 26. Institutions use algorithms like target close to sneak large positions through at the final price of the day. It confirms their long-term intent. They're building a massive position quietly.
Fairfax owns 16% on the long side, and the short float is 16 to 17% on the short side. With Fairfax locking up so much supply, the available float is severely reduced. So if that technical buying pressure you described suddenly fails to materialize, the remaining bears are going to be aggressive, and there's less liquidity to absorb their selling. It could quickly overwhelm that 450 support zone.
That's the risk the shorts are facing, though. The diminishing float actually exacerbates the pressure on them, increasing the probability of a squeeze if any positive news breaks. But let's look at the technical structure itself, which suggests we are already transitioning. The chart is moving into a classic accumulation phase. We broke the upper trend line of a multi-month falling wedge pattern, which is one of the most reliable bullish reversal signals there is.
I see the chart differently. For me, the primary technical conflict that matters to any long-term trader is still the 200-day moving average. Until the stock can achieve a definitive daily close above that level, which ranges up toward 550, the macro long-term trend remains bearish. Period. The current rally is simply consolidating above immediate support. It hasn't fundamentally broken the ceiling of the bear market. We are still waiting for confirmation that this is anything more than a significant counter-trend bounce.
But we have powerful confluence building support. Reclaiming the 50-day moving average at 453 provides critical intermediate-term psychological support. More importantly, that technical floor is explicitly reinforced by Fairfax's cost basis. It aligns perfectly with our support zone. You have technical support reinforced by high conviction money. A decisive close above the 477 to 485 resistance zone will trigger a significant technical breakout, a golden cross watch, which will force trend-following funds that have been short for months to cover.
I'm just not convinced by that chain of events because it puts too much faith in technical follow-through. What if it fails? If this rally fails to hold the pivot point of 466, it risks invalidating the entire bullish thesis we've discussed. The falling wedge, the 50-day MA, all of it. We are still dealing with a stock under a major death cross overhang, and failure here exposes the stock to a retest of the 413 lows, which is right where many of Fairfax's recent buys sit. The stock is highly sensitive to failure right here, right now.
So look, we can agree that the convergence of that extreme valuation disparity, the positive short-term technicals like the RSI and MACD, and of course the high conviction signal from Fairfax, it all creates a compelling accumulation setup where the market has likely overpriced the risk of failure.
And I'd reiterate that, while the Fairfax signal is massive, you can't ignore the structural issues. The guided revenue decline, the brand perception risk, and the fact that the stock is still trapped beneath that crucial 200-day moving average, it all suggests the bullish case is premature and highly reliant on a very difficult multi-year turnaround actually succeeding.
Under Armour is, at the end of the day, a complex case study in distress investing. It's caught in this dramatic tension between high-conviction institutional buying and a very deep, very real retail pessimism.
And understanding both sides, the deep value thesis rooted in that profoundly discounted 0.56 price-to-sales multiple and the persistent operational and brand risk is absolutely essential to evaluating the true long-term path forward for this equity.
If you enjoyed this video, subscribe to the Stock Market Palantir channel for more stock reviews like this. Thanks for watching, and see you next video.